folks. Welcome to bread and butter turtle soup models. To begin with, let's clear some misconceptions about trading models. A trading model, it must repeat every day. That is correct. Why? Because whatever happens on the higher time frame happens the same exact way on the lower time frame. Because price is fractal. So is time. A trading model must be easy to understand. A trading model must be interpreted by two parties in the same terms. So it must be concrete and transferable. Finally, there is no holy grail. There are only probabilities. Some are simply higher than others. Some models are simply higher probability than the other ones. A trade model guide. Every trade model boils down to these three things. Number one, an entry. Number two, an exit. And number three, a stop loss level. Entry, of course, can be both price and time. I'll go briefly over three specific models. First of all, the 3-candle model. Second of all, model number 1, plus. And third of all, a quick buck model. Before delving into the models, here's the base of every single high probability model. It's a consolidation, turtle soup, expansion, market structure shift, a true market structure shift, which happens in the form of a consolidation, expansion, retracement, and expansion. All right, so when you mark a key level, this is what you look for. So expansion number 1, then the OTE, expansion number 2, and vice versa. Consolidation, expansion, leg number 1, and then you smack back into the consolidation over here, which leads to leg number 2. All right, so this is an opportunity, and this is also an opportunity, and the OT is the turtle soup every single time. All right, so the psychology is that the people waiting to buy the key level, they get chopped up, they FOMO, they buy early. It then stops them out, induces short sellers, shift, wrecks everyone, goes through the high, they buy up here, they get wrecked again, the OTE wrecks them one last time, they sell down here, it's breaking down, but no, the structure has shifted, the market is now bullish, and once you break a high, then you dump below a low only as a turtle soup to rally again. All right, here's a depiction on the chart. Key level, you're going to have a low, a high, a lower low, a higher high, so you close above the high that broke the low. Remember, chapter 2, market profiles. And then you got an OTE, turtle soup, and then you rally. Leg number 1, and there's an extremely high chance when you have this formation of leg number 2, and it's going to be the same size as leg number 1. That's your target, right? That's price-wise. How about time? Time. The high of the daily candle forms at London, right, which is 1 to 5, with an OTE at New York, around 8 to 10 a.m. And this OTE will continue the direction of London or reverse in the direction of the weekly candle. This is the daily candle, right? Next up, you have the weekly candle. The high or low of the weekly candle forms from Sunday, Tuesday, Wednesday. Sunday to Tuesday. During the London session of Tuesday, right? So that's the time zone you're looking for the high or low of the week to form. And the opposing end of the range, with a double P of course, is capped on Thursday and Friday. The high and the low, the high or the low of the monthly candle will form in week 2 and 3 of the month. These are also the 2 highest probability weeks of the month. SMT is crucial. SMT is available at all the important highs and lows. Next up, we have the 3 candle model. So we're going to go straight into the models. All I ever need to trade is 3 candles, and you'll see. And if you study this the way you're supposed to, then all you'll ever need is going to be 3 candles, right? The most common and obvious 3 candle model trades or models are the Monday range and the Asian range model.